So let's start by breaking down a couple of stereotypes about real estate investing and how people typically approach it. And I'll share with you one approach that you should consistently use when investing in real estate on a regular basis, year after year. First, let's talk about how people, when investing in or buying real estate, are often influenced by messages from the media. I'll give you an example. Near the United Arab Emirates, there have been, and still are, the Houthis in Yemen. It's a militant group that's against the US. And when they started again recently, seizing ships and cutting off
Cables?
intercommunal cables, then people influenced by the news started saying that, well, in the UAE, as soon as the first bomb from the Houthis drops, everyone will leave. The fact is that this risk has existed since around 2013, 2014, 2015. So it's been around for a long time, but for some reason, people only start talking about it when some news appears in the media. Before that, no one pays attention. And this happens over and over again. Really, news can be both good and bad, and people start relying heavily on the media at a specific moment in time. And I'm saying this because in the real estate market, in order to beat the market and win in most deals, that is to profit from investments and lose very little because losses are inevitable in any case. The question is, how many deals will you make? If you make 2,000 deals, obviously you'll have a certain percentage of losses.
Mm-hmm.
If you've only done 2 deals, then they're probably both successful. It all comes down to volume. That's why professional investors or managers, whether in the stock market or real estate market, understand that you just need to consistently aim for returns above the market and losses below the market on average. In the real estate market, there's a problem in that no one sees these ratings. No one really understands how much on average people are losing or earning in the market. There's only limited data on how much the market has grown, and that's basically it.
Mm-hmm.
And that's why the real estate market as an investment space is so opaque. No one really knows who the leaders are and who the losers are. What I'm saying is that in order to succeed in the real estate market, to significantly increase your chances of success and seriously reduce your risk, you can follow 2 models. People usually try to predict the future, like will there be a war or will there be an earthquake in Turkey and so on. But those kinds of things are impossible to predict. If you actually can predict things like that, then it makes more sense not to invest in real estate, but to invest in stocks, because you can make money faster and a lot more of it if you can predict those things.
And you can create your own platform with your logo right at this link, brokered with .realist.ai. You simply click here to create a platform, choose whether you are a company representative or an individual. Then click here, enter your unique address, and click Create Platform. Now you have a unique link, and you can share this unique link with your clients or meet with them, open this link, and show it. Now all the power of Realiste is in your hands with your own platform. Now you can view all the projects available in the United Arab Emirates here. You can even access analytics. What prices are available in which areas right now. You can even see what the rental yield is now, in which areas. And you can even show your friends and clients which areas have increased in price over the last 12 months. The platform operates in many languages. You can change the language and it will work in your language. Here you will find all the projects across the United Arab Emirates. You can click on a specific project and you will see all the data on this project, including what infrastructure currently exists nearby, what future infrastructure is planned, what the prices are, and how many similar apartments have been sold in recent weeks. And you just click and immediately receive a ready-made pre-application from the developer. All of this is free, the entire technology is free, and you can use it at any time. You can go to the Realiste's website or click to show for referral rewards and receive up to 90% of the reward for this deal. Ask our manager about any developer and you will receive a link to the direct representative of the developer. Just write to us here and you will receive the information on WhatsApp.
Unfortunately, at the same time, people start talking about a black swan event, like, well, what if a black swan happens? But I think people sometimes confuse the basic concept of a black swan with what they actually mean. The essence of the black swan, as Nassim Taleb puts it, he has this comparison, is that just because something hasn't happened in the past doesn't mean it won't happen in the future. Because all investment models, or at least most stock market investment models, are designed to predict the likelihood of an event based on the past. Just like people hadn't seen black swans before Australia, they assumed it was impossible, and then they saw one. That's the kind of example he gave. The point isn't that bad things happen. The point of the model is that if you study only historical charts and you haven't seen something happen before, that absolutely doesn't mean it has a zero chance of happening in the future. It's a slightly different model. People usually think that a black swan is, say, a war, or, for example, a war in the Middle East. But that already happened, so it's no longer a black swan. It's a known risk. A black swan, again, is something that hasn't happened before, or the probability of the event is so low that it's not even considered, and yet it can still occur. And many investment managers have failed because they believed it was absolutely impossible. There was a fund called, there used to be a fund called Long-Term Capital. They were unexpectedly impacted by a black swan, especially when Russia defaulted in 1998. And then there was also a significant crisis in Asia. They ended up with a hole of about $1 trillion. That's what we were talking about. Now let's move on to real estate. So in real estate, it's hard to predict the future of a country or a city and its surrounding areas 3 to 5 years ahead, especially when it comes to so-called black swans. That's why I would just take that out of the equation and not rely on it. Because if you're actually good at that, then you probably shouldn't be in real estate. If you think you're good at it, then most likely you're overestimating the risks you know about and underestimating the ones you have no idea exist. In real estate, it is much more important to be able to study the market, areas, projects than to predict the future, because you can actually influence the market you choose, the neighborhoods, and the building. You can't influence major events on a global scale, like a war or something similar, in any way, and you can't predict them either. When will the war between Ukraine and Russia end? In 6 months, in 2 years, in 3 years? Who knows? Whoever does know is probably investing in Ukrainian and Russian bonds, but definitely not in real estate. These are the kinds of nuances, yes. So we just set that aside and don't pay attention to it because it's something we can't influence. We can't know it. And if you do know how to predict it, then why are you in real estate? So now there are only a few elements left in the equation. And I want to illustrate a simple yet profound and potentially transformative idea, which I believe will be both useful and insightful for our understanding. Let's take a moment to imagine that the entire real estate market is composed entirely of this specific and significant number of cells. That is, all the real estate that exists, for example, in the United Arab Emirates or in Dubai. Usually, any market functions like this. About 10% are green opportunities, the most optimal prices, the fastest growing areas, the greatest potential, and the absolute top of the top. That's the 10%. Most of the opportunities fall into the yellow category. This is where you earn either simply from market growth or you earn at the market average, from rent and so on. There are no extraordinary opportunities here for making big profits over time. And there are always at least 30% that are red opportunities. Red opportunities are where people will obviously lose money. Right now, the price is too high, and it will be in the future as well. There are no clear prospects and so on. So, roughly speaking, the entire market can be divided this way. But in reality, the whole market is much bigger. Let's take a look. This is what the market in the United Arab Emirates will look like. I hope it's visible on our screen. This will be the United Arab Emirates. And if you extend this column, these columns, all the way to the right, that would represent the entire world. So as you can clearly see, it all is heavily dependent on the scope of the overview. But often real estate investors focus only on this limited volume and understanding. They don't see the whole market. They don't understand. They can't compare the red with the green because they're only focused on a couple of neighborhoods or 5 or 6 projects that were sent to them by realtors, or maybe they look through 20, even though there are around 400 projects in Dubai today. Is it possible to review everything manually? No. You choose a segment, luxury real estate or business, and you focus only on that. Even within each segment, there are about 50 projects, and annually between 50 and 100 new ones are launched. It's extremely difficult to analyze everything manually. That's why the first problem investors usually face is that, for the most part, they end up with this kind of choice. It's either the yellow or the red, because both yellow and red in particular constitute the majority of projects in a given city. And they end up choosing either from the yellow or from the red. They almost always never successfully manage to get into green projects because the chance of them finding one and opportunities within a narrow selection is very, very low. Extremely low. So it's either red or yellow. With yellow, you earn something. With red, you lose, or you end up stuck in that property for a long time. That's why the first principle in real estate that allows you to beat the market is to look at all the projects from the top down and be able to segment them into potentially green ones. And then you study those potentially green ones thoroughly. Because when you buy real estate, there are about 100 risks that could happen with that property. What kind of risks? Will they build a house nearby that blocks the view? Is the developer reliable? Yes, certainly. Does he consistently deliver on time, or might he fail to complete the project on schedule? Will you buy the right apartment that has liquidity, or will you end up buying something illiquid? And many other such risks. Will they build a school nearby or not? Will they build a lagoon nearby or not? There are hundreds of such risks. To check all these risks, you can't go and verify every single one for each project. Today, artificial intelligence helps, maybe not to identify every risk completely, but to account for most of them. And first, how do you get into the top 1%? At Realiste, they've already created a system that accumulates all this knowledge. It's not absolutely perfect in the sense of click and buy. You still need to apply your own knowledge and refine the information in any way. But still, now it's very easy and convenient to choose what you need real estate for. Say, for investment, you choose your own strategy. Are you a more conservative investor focused on rental income, or are you counting on buying and expecting property value growth? Or maybe you're getting into projects at the very early stages. In other words, you think you're entering projects with the best price because you're buying earlier than everyone else, because that's not always the case, but still. Next, you choose your budget. Let's pick a budget around $2 million, from $1 to $2 million. And let's take a look. The advantage of artificial intelligence is that it immediately ranks everything from the most interesting to the least interesting. And it's easy for you to focus your attention first on the most interesting ones, work through those projects, and then move on to the less interesting ones. So you don't need to start with the less interesting ones and work your way up. And you don't have to click around at random, because when realtors send you selections or PDFs, you have no idea what range you're actually looking at. It could be from the green range, the yellow, or the red. They can send you projects from all over the spectrum. This is only the green range, which is where you should start your analysis. This is the first principle of investing. From the entire volume, we select the top from the green range, the top promising ones, and begin to work through those further. There are many ways to analyze it. You need to consider what the demand dynamics are, whether people mostly buy 2-room, 1-room, 3-room apartments or penthouses. For each of these questions, there is already an answer in artificial intelligence. Let's take downtown as an example area. You need to understand that there, 1-bedroom and 2-bedroom apartments are the most commonly purchased and so on. You go into the transactions, a total of 3,400 transactions have been made. Let's see how many 1-bedroom units were purchased. Half of the market is 1-bedroom units. Roughly about 40% are 2-bedroom units. There are 500 3-bedroom units and around 100 apartments with 4 or more rooms. So if you're buying a 4-bedroom apartment in downtown, you need to understand that only 8 such large apartments are sold per month across all of downtown. The liquidity of such project is practically zero. People simply don't buy such large apartments. Why? Well, living in downtown with a family and kids is probably not that easy. That's why there's no real point in buying huge apartments, and so there's no organic demand for them. Let's take a look. There are no studios, only 1-bedroom units. In downtown, the best option is to buy 1 or 2-bedroom apartments. 3-bedroom apartments lose liquidity and 4-bedroom units drop to zero. So the answer to the question is you should buy either 1-bedroom or 2-bedroom units. Next, you can look at the quality of the building, such as the overall structural integrity and what kind of demand there is. For luxury projects, it's 600. Business class, 900. So if the difference between business class and luxury isn't that big, then you should buy a 1-bedroom in a luxury project. If only 100 luxury units were being sold and 900 business class, then it would make more sense to buy business class, a limited number of luxury 1 and 2-bedroom units in downtown. You see how the segmentation works, right? This comes after you choose the market, after you choose the project, and after you choose the district. So there's already an answer to each of these questions, and I think we'll put together a checklist and share it with our viewers. So write to us if you'd like a checklist on how to evaluate an investment, what to pay attention to. There will be direct links in it.
Yes.
Here's a question. Here's answer. Here's the answer.
With screenshots too.
Let's do it that way. Yes, we'll provide it. Let's move on. That was the first principle. Out of everything, you need to choose the green opportunities and then analyze them in detail by answering the questions. Then your chances of success increase dramatically compared to the overall market, and you're not limited in your choices when you're only offered 20 or maybe 10 projects that someone else selected. Obviously, that person wasn't looking from a bird's eye view. They could only look based on you, your request, and so on. In other words, the more limited your options are, the more you realize that mathematically, you're most often ending up in the yellow or red zone. And this principle is practically not being used by anyone right now. Most people operate based on the yellow or red zone principle. And that's a big advantage because not many people or investors have realized that this is the way to go. You know, in trading, this could be called algorithmic trading, right? That is to algorithmically choose real estate, to approach it with a cold heart and look at it primarily from a numbers perspective. And only then add your emotions and ask yourself, would you buy this? Would you live in this project or not? Instead of doing it the other way around, falling in love with the project first and only then looking at the numbers.
That's how it happens.
First look at the numbers and only then view it from a subjective perspective. That's the first principle. Let's talk about the second principle. The real estate market is based on information asymmetry. Information asymmetry means that not everyone has access to the same information. For example, if we talk about a district like there's an important event that's going to happen here. Specifically, a lagoon will be built. And the big question is, will it be a lagoon or will it be a canal? Very few people actually know whether it will be this kind of lagoon or that kind of canal. It matters. And information asymmetry exists in the real estate market, not only regarding future infrastructure, who will be building, what projects will appear, and so on. Information asymmetry also exists at the level where people have seen something somewhere, but don't know exactly where it will be. Like, where exactly will these be? Or where exactly will the bike path be that's supposed to run across all of Dubai? The specific location where it will pass through and where the entrance to this bike path will be. It's going to be, I think, 40 kilometers or more. Exactly. This is the asymmetry. Some people know the exact locations, AI knows the exact locations, but most people don't, even though they know it's going to happen. If you know exactly where it's going to be, you understand which location near this infrastructure will grow. That's information asymmetry number one. Information asymmetry number two is that the real estate market is slow to react to events. Let's imagine that tomorrow something bad happens in the United Arab Emirates. The kind of risk we talked about, like the Houthis launching a bomb and it hits, the real estate market won't change prices overnight. It will change over approximately 6 to 9 months, responding to major macroeconomic events. That's what happened in 2008 in the United States. The real estate market didn't crash in a single month. The real estate market declined over 9 months. And the most interesting part is that if you can forecast demand in advance, if you can predict what will happen to real estate ahead of time and be the first to exit the market, then you win. Because if everyone lost and you lost the least, that's still a win. If you didn't lose while everyone else did, that's also a win. If everyone made 1% and you made 5%, that's a victory. It's simply an opportunity to outperform the market. And that's why we developed this kind of technology. This technology is designed so that you can input all your assets, all your apartments, and receive a daily valuation of those apartments and see what's happening with that real estate every day. You can also track the performance of each of your apartments, of each of your assets in Moscow, Dubai, or other regions of the world, and everything will be in one place. You'll also receive recommendations on whether you should keep a particular property or consider selling it. Soon, we'll be adding future forecasts to show what's likely to happen with a specific apartment. Of course, it's impossible to predict all geopolitical events, but it is possible to quickly model and forecast rapid market dynamics. So if something changes, the chart adjusts and the trajectory dynamics shift. This system helps you respond quickly. If all your charts start trending downward, you already know that, first of all, most people aren't aware of it yet, and you can react faster and exit the market selling at a discount. But the main thing is to avoid getting caught in that downward wave. And in this way, you protect yourself from risks and from losing money. Most of the time, people lose money in real estate because they don't react in time, enter during a recession, and property values start to visibly plummet. It can drop by 30 to 40% over 9 months during the most critical periods. But such moments only happen about once every 10 years.
Moscow and Dubai.
Here we have Moscow, Dubai, Riyadh, and all the other cities will follow, all in one place. This is the second principle, information asymmetry and market speed, where you simply need to be quicker and more efficient than the rest in the market. Being faster than others really helps you avoid bad investments in your investment strategy. One more, a key effect. You need to know and be able to predict the future at least 6 months ahead. At least 6 months ahead. That's very important. Look, again, saying predict the future 6 months ahead was probably not the right way to put it. The right way to say it is to see 6 months ahead more clearly than others do. Because the real estate market works like this. Someone pays for that success. If your property quadrupled in value and you sold it, then someone came along and paid for it.
So they really lost?
Not necessarily lost. They might live in it, yeah, for like 20 years, and they don't care whether they make money on it or not. That's possible. But one way or another, someone has to pay for that success, for that property growth. Yes, that's why someone always wins a small amount, just like in the stock market. About 10% of people make money and 90% lose. And the earnings of the 10 are based on the losses of the 90. The money has to come from somewhere.
Makes sense.
In real estate, it's almost the same but better, because in real estate, there are also end consumers who are sometimes willing to pay any price. They take out a mortgage and their money gets spread out over 20 years. That's why investors always have an exit. With stocks, what can you do with stocks? You bought 1,000 shares of Tesla. Are you going to go to a Tesla shareholders meeting, vote, and influence their decisions? Well, most likely not. You just hold those shares hoping they'll go up in value, but you can't actually use them. At most, you'll print them out and probably wrap some sausage in that stock certificate. That's about it. What else can we really do with it? But still, in real estate, there are end users and accordingly an exit. There's a kind of consumption chain and a production chain, and there's also a sort of food chain of investors and so on, which we talked about in the previous lecture. We'll definitely leave a link here about the investor chain. If you're interested, check it out. One last thought, so we don't drag out this lecture, because if you want to dive into all the details, we'll leave a link to an article that explains in great depth how artificial intelligence will impact the real estate market, how the investors who use it will outperform everyone else, and how the real estate market works in general, including its fundamental lags.
Yes.
When you observe the real estate market for a long time, you start to notice patterns and connections. How is luxury real estate purchased? What principles do people follow? If you know that, as you might already be aware, then indeed, as a financial investor, you're often playing against everyone else. You know how to outperform the others. How is resort real estate purchased? How is real estate bought in cities like Moscow? How is it sold? How does it grow? What are its principles and so on? All of this is described in a huge article, but it's very detailed. For nerds,
For an advanced level, exactly where to start.
That article is at a super advanced level. It includes a lot of nuances related to the stock exchange, technologies, artificial intelligence, and more. So the last thing I wanted to say is that you need to be able to see 6 months ahead. We created such an algorithm in Realiste. Look, for example, in Dubai, everyone sees the DLD. These are public government transactions that are visible to everyone. All realtors see them, as do all clients and investors. Everyone is watching this. But there's another very important aspect, bookings. Bookings are our technology. We collect data from developers. They send us their Excel files and PDF files with inventory, with the apartments they want to sell every day. And since they send them to us daily, we can analyze what has been removed from the files over the previous day or week.
What gets booked?
What gets booked? Because the primary real estate market in Dubai works like this. You come in, buy an apartment from the developer, make a booking, and pay 24%. And the SPA, yes, the sales and purchase agreement, you might receive it with a delay of 3 to 4 months.
So official stats don't reflect the real picture?
The official statistics reflect the real picture, but with a delay.
Ah, I see.
And that delay is on average 4 months.
And with bookings, can we see daily data?
With bookings, you can see what's happening right now.
Got it.
So this is the kind of data that everyone else will only see in 4 months. So it's not just an opportunity to make predictions. It's literally a chance to see what will happen with the official chart that everyone will rely on and that all the newspapers will write about.
I think I'd recall a story here. The one we even published an article about.
This isn't insider trading.
No, it was when everyone panicked that the market was falling in Dubai because the official statistics showed low sales.
Yes, let's add a screenshot of that here too. There was a case when, in the Dubai registry, October or November, I think, it was officially shown, and this statistic was up for a month and a half, that the new construction market had dropped by 70% compared to the previous year. And I kept looking at it for a long time, thinking they would fix it, because our statistics showed that bookings for new developments were going up, selling very quickly with a growing momentum. We waited for a month and a half, and in the end, we couldn't take it anymore. I realized that rumors had already started spreading that Dubai was finished.
Yes, bloggers started talking.
Bloggers started talking, everyone began showing that data and so on. We published an article and explained that there was no need to worry. It was most likely a mistake, some kind of oversight. Our statistics showed that everything was growing. A week later, everything changed in the registry and they found those transactions. In the end, we looked into it. They had lost 80% of the transactions, apparently due to some kind of error. But how does it work? Everyone started to panic because they all looked at this official ranking.
Yes, we have a lot of stories like that in general. Thanks to these forecasts, we can see 6 months, even a year ahead. For example, at the very beginning of 2023, Literally on January 1st, we released a forecast on how the real estate market would behave over the next year. In the end, it turned out to be 99% accurate. I think we'll attach a screenshot here as well.
Yes, we'll include it. Just a small disclaimer. It's impossible to predict everything with full accuracy, but you can outperform others. See more. That's the main principle. Why is it advanced? Because people who are watching this video now, who are buying their first property in their life, obviously won't be guided by these principles. These are principles of big data, analytics, and so on. And again, this principle is more of a professional one, more related to the stock market. Those who deal with stocks will understand what I'm talking about. You know, I want to tell you that for those who are familiar with stocks, over the entire time we've been working with our algorithms, we've made 430 trades as of today. The Sharpe ratio was over 6.0. Know the Sharpe ratio?
No.
Well, in general, you don't need to. And for those buying real estate for the first time and watching this video, my advice is to use the technology. It's free. Check the data through it. And when someone offers you a project, take a moment, don't be lazy, and verify that information on Realiste. Because we professionally focus on collecting all this data, cleaning it, making forecasts, and creating the most accurate database and the best technology in the real estate market worldwide. Just go check it out and see for yourself. And if you definitely purchase with us, you'll also get lower prices because we offer special conditions specifically for those who choose to make their purchases through our platform. Those who buy online are buying with realtors. Realiste is not against realtors, but at the same time, Realiste simply offers better analytics and better terms for clients. And at the same time, we are probably the only ones who have digitized all our transactions and publicly show how many deals have been made, the results of each deal, what investors bought, what they received, and at what price they sold it. Or if they haven't sold it, what the current estimated value of that property is. This is also publicly accessible. That's it. For today, we'll probably wrap up on the strategies. If you'd like to see much more detailed points and how to manage these risks, leave us a comment under this video or message us on our Telegram channel. We'll leave the link as well, and we'll send you the file with all the risks and where to double check them.
Yes. Thank you all for watching. The link to the platform Alexei demonstrated is in the description. The article is too. All materials are in the description.